Hi and welcome to this new episode of Your Next Trade. So happy new year to you. A lot of good things happening to you in 2023. Amour, gloire et beauté. Let's look first at what happened this week and why I call this new episode that the trading range might be over. So looking at the year-to-date asset performances, which is the same as the week-to-date, obviously, we had stocks that did pretty well in Europe and in the US. What is interesting is Europe has been outperforming quite a lot the US this week and since the lows of September. In terms of FX, we had a bit of a move on the week, but overall the dollar has been is back more or less at the levels that it was last week. A bit of crypto excitement at the start of this year, and the gold as well, interestingly, is starting to make a move. So gold is up 2% on the week. I think this is one to be looking at. WTI very weak. It feels to me, as we're going to be looking for the technical analysis, that there is a good chance that it might go into the 65. So what about the week-to-date industries performances? Almost all of them were positive on the week. Only the cloud, cybersecurity, software, so some of the ones that struggled last year are doing the same. The second derivative of the gold, which is the gold miners, or the high beta of the gold, have been doing pretty well. Airlines as well, with the hopes of the recovery, and as well, more importantly, COVID reopening in China. So airlines doing well, social media, some others. S&P really is here, so that tells you that many industries outperform the overall S&P. What about the week-to-date and the year-to-date sectors performance, which are the same? So the telcos pretty strong on the week, up 5%, so really outperformed the market. Financials as well. So for the telco, there is one reason is the cost of money. The US 10 years is down, the US Treasury is down 30 bips on the week. So that is helping this sector that is using a lot its balance sheet. Financials, there is a bit of expectations that there's going to be a steepening of the yield curve. Plus, I think it's mostly about the end of the week. So at the end of the week, we get the start of the earnings season with most of the banks. So that helps. But overall, market did pretty well in the US, mostly on Friday, as we're going to see later. What about the rates? So as I just mentioned, US 10 years bonds, most of the bonds, the yields are down. So prices have been going up for the bonds. US 10 years now sitting at 3.56. You might remember that at the end of in December we had a bit of move up for the yields, so there is a bit of reversion to the mean, over the last 6 weeks. Interestingly, the 10 versus the 2, so steepening or not steepening. So if we look at the 10 versus the 2, which is now sitting around minus 70 bips, there are a lot of calls from smart people actually that are calling for a steepening of this yield curve in the US, even if there is no recession. So if you get a recession, there is a good chance that suddenly this negative 10 versus the 2 is going to turn positive very quickly. Why? Because the Fed will have to be very aggressive in cutting rates. But even if you do have some reversion, we know that there is some positioning, extreme positioning on the 2 years, for instance, that calls for the 70 bips, the minus 70 bips to go at least from minus 20 to 0. So in terms of positioning and one of your next trade that I think offers good reward is the steepening. Having said that, this market is very much looking for pain. So I won't be surprised to have the pain trade first, and then this steepening. Euro dollar, so here we are looking at the expectations for the FOMC from the Fed. So the terminal rate that we have been covering for over the last 6 months. So the terminal rate in June, literally this is the peak where we expect the Fed to be around 5 to 5.2%. And after that, you see there are many cuts. So cuts from June onwards after. That tells you something. So on one hand, you get the market, the euro dollar market and the Fed funds market pricing from June the Fed to be dovish and to be cutting rates, and versus that you get many or almost all Fed speakers saying to us, we're not going to have any cuts in 2023. Very often what happens is the Fed is late, as you know, they were late to fight inflation, and they might be late as well on the other way around. So it's for the time being, there is a kind of a fight between markets positioning and what is the Fed telling us. Interestingly, if you look here at this chart between the last and what was the positioning on the euro dollar at the close of the last FOMC meeting, which was on Wednesday, the 14th of December, we are almost at the same level. So not much of a change over the last 3 weeks. A lot of noise, but really the positioning has not really been really changing. The VIX, we are in the low 20s now at 21.1% contango. So picture is the same as before, and as long as we don't see, we don't have more clarity, it's going to be hard to go lower than this 20% on the VIX. Let's jump now into the technical analysis, starting with the S&P. So as we covered, that was in November, December, we touched this downtrend. We are still in the downtrend, but more importantly in the short term, and this is why I call this session is the trading range over. As you can see, over the last 12 days, we have been trading on the S&P between 3920 and 3800. So that's roughly 2 weeks of range now. So we came down just after the expiry. And why? Because for those of you who are more following options, you do know that JP Morgan, their big fund, which is one of their funds is holding quarterly position, and their quarterly position at the end of December had a big position at 38.35. So we went to the 38.35, and now we might be resetting. But what has been happening is we got 2 weeks of chop of 10 stable between those 3800 and 3920. So now going forward, what are the next level? If you break this 3920, you're going to have the 200 moving average, which is around the 4000. The level here is around the 4030. So you do have like 2 to 3% upside from this level. I won't be surprised, as usual with this market, to see some bull putting some position and actually the bull trap, and then we go lower. So as we're going to see later, many drivers coming. Same picture for the Nasdaq. We are trading in a range here. If you look at the Russell is making a higher high on the 2 weeks. So we do have some drivers like emerging markets. So emerging market, obviously, with China reopening, EM is made of 60% roughly of China, so that helps. It is trading now above the 250 days moving average, so big positive. And if China carries on like this, obviously EM might outperform the market. Looking at SXXP for Europe, looking at the Stock 600, picture is the same. We are at the top of the trading range that we had so far. So here, similar to the others, can we go higher? CL1 stands for WTI, and for the futures, this is still in a downtrend. If you look at the chart, if you look at point and figure, there is a good chance that we might go into 65. If you look at copper now, copper similar, we are at the top of the range. So many asset classes that are trading in a range or at the top of the range. Euro dollar, a bit of a noise, and trying to digest this big move that we had since October. You will need a proper catalyst to go above the 107. Dollar yen is the same. We had a big move and we are digesting the information. Taking only one stock here for this week, because the JP Morgan is coming with their earnings on Friday, and this is the market leader for financials, and this is really the biggest company, the first company to start any earnings season. As you can see, this is similar, top of the range. So each time you're gonna have a catalyst like we're gonna have this week, the market is really on the verge of breaking out. Why? Because the market is looking for new catalyst. So what has been happening this week, if you look at the price action for this week and the events that we had, so the market was closed on Monday in the US. We had the ISM manufacturing that was more or less in line in the US. And on Friday, that was really the big day. That was the big day for numbers. We got the NFP for the unemployment in the US. First thing first, the headline number was a bit better, so a bit more job creation. And the positive news was on the wages. That was a bit less than expected. So the market didn't do much. Really was trading around 38.30, 38.50 on the S&P. Then actually we had the bad news from the ISM services. So the ISM services went from 55% in November to 49% in December. And the new orders were really bad. If you had a better look or in-depth look about this report, really it's not that great. So the market took it as the good news is bad news. In other words, having the Fed probably less hawkish than it was before the report, but that tells you as well that it increases the odds of hard landing versus a soft landing. So far services were holding very well. That was really one of the few pieces to hold pretty well in the US. Now, question mark, if it's only one number, it's only one data, and you don't make a trend from one data, but that is really a bad event. So looking at the price action of the S&P, as you can see, we are not trading much and not doing much in a small range. Then we moved up after the ISM services, and as I said, good news was seen as bad news bad news was seen as good news, so that's the other way around. So that means we are expecting now the Fed probably to be less hawkish than what was expecting 3 or 4 weeks ago. What about the Europe versus the S&P? So as I mentioned, as you can see, Europe has been outperforming the S&P recently for many reasons, as I discussed yesterday during the 2023 webinar for ID generation. It is pretty clear that the economic numbers from Europe have been much better than expected. So the expectations were pretty gloomy at the start of September, and since then the European economy has been doing pretty well. What about the catalysts? So the catalysts are mostly, you're going to have 3 of them. You're going to have on Tuesday Powell that is doing a conference. Then on Thursday we get the big number, which is the CPI, so that stands for the US inflation. And then on Friday we're going to have the start of the earnings season. So if we look first at the CPI move and how the market has been doing more recently, so that is here. As you can see, recently over the last 2 of the 4, were pretty much up like a lot. Why? Because the CPIs, the numbers that were released were better than the expectations. But what is interesting, looking at your next move, if you look at the absolute average move over the last 8 times for the CPI for the day for the S&P, the move on average was 2.6%. If you look at the move that is expected from the SPY, from the options on the day, the market is now expecting 2.4%. So in other words, the market is digesting in a better way the Fed, the CPI, and the noise that could come from inflation. So that tells you really that inflation, the volatility is coming down. If you look at the straddle for this week, so looking at the SPY straddle, market is only I don't know if it's the right word, but it's now pricing 2.6%. So implied volatility, realized volatility is coming down, and that is very often the case for when market participants think that there is better visibility. Is it really the case? I'm not really sure that we do have like better visibility, but what's going to be important is on Tuesday Powell is talking, and then at the end of this month we have the FOMC meeting, so the release will be on the 1st of February. You do have like some other Fed speakers, and really the big thing going forward between the 15th of January and the end of the month with the FOMC meeting will be the earnings season, which, as I stated before, started on Friday with JP Morgan, Wells Fargo, Bank of America, Citigroup, tons of names the weeks after. What is interesting, if you look at the chart here, you can see that the expectations from since September to December have been lower quite a lot, by 6.5% for this quarter. That's a bit less than the previous quarter, but over the last 2 quarters, expectations from analysts have been coming down a lot. So on one hand, you can argue that maybe some is priced in, and on the other hand, what is priced in if we are facing a recession? So that is still the question. As we've covered today, many asset classes have been consolidating or trading in ranges. We are talking currencies, we are talking FX. Sorry, we are talking currencies, we are talking stocks, and that's not only in the US, that will be in Europe as well. So we have catalysts coming. If there is a move, if there is a breakout, that is probably the time to jump into risk on. My view is feels very much like there is poor visibility for the time being, and I'm not sure that until we get more from the FOMC that it is worth really playing those breakout of ranges, and feels very much like there is a chance that we could have some bull trap. So if you are looking for more learning into this year, you can have a look at the website 4x4 video series and or the mentoring. Subscribe to the YouTube video, that is helpful. And please, if you want to learn even more, you can join the trading community. We are on Discord, it is for free. Any question, you can reach me and send me an email. And have a good week with a lot of trading range that are to be watched. All right, everyone.